There are moments in financial history when a quiet shift begins beneath the surface, unnoticed by the majority, dismissed by the comfortable, ignored by those who still believe the system is functioning normally. February 2026 is one of those moments. The numbers are not small anymore. Gold is trading near $5,000 per ounce after touching levels above $5,500 only weeks ago. Silver is moving through the mid-70s, having already surged more than 130% year over year. These are not ordinary price movements. These are not the fluctuations of a healthy, balanced financial system. These are stress signals. These are pressure fractures spreading through the foundation of global money. You are witnessing this in real time. Markets are volatile. Central banks are trapped. Debt levels are historically unprecedented, and yet most people still behave as if nothing fundamental has changed. They still measure wealth in currencies that are losing credibility day by day. They still believe corrections mean safety has returned. They still assume the system will stabilize because it always has before. But history does not repeat by preserving stability. It repeats by revealing fragility. And now we need to talk about the signal that almost nobody is interpreting correctly. Silver is moving in a way that violates the normal order of the financial cycle. Traditionally, gold leads during fear. Silver lags, then accelerates later when speculative and industrial demand converge. But what is happening now is not simply a late cycle rally. It is something deeper, something structural. Gold is rising. Silver is rising. Equity markets in several regions are still elevated. Bond markets are unstable. Real yields fluctuate violently. The dollar strengthens in short bursts, then weakens again under the weight of debt issuance. These correlations should not coexist. They contradict the old rules of capital flow. In a functioning system, capital chooses. It flows toward safety or toward risk. It does not rush toward both simultaneously. When everything rises together, it is not a sign of strength. It is a sign that the measuring unit itself is failing. This brings us to the most dangerous signal of all. Assets are not rising because they are becoming more valuable. They are rising because the currency used to price them is losing trust. To understand this, we have to step back and confront the real cause, the force that has been building for more than a decade. Global debt has crossed thresholds that previous generations would have considered impossible. Governments borrow not to invest, but to maintain existing obligations. Interest payments alone are becoming structural deficits. Central banks, trapped between inflation and insolvency, attempt to maintain liquidity while pretending to maintain discipline. But liquidity is not neutral. Liquidity is dilution. When central banks expand balance sheets, when governments issue debt at accelerating rates, when financial institutions rely on constant refinancing, the supply of currency increases faster than the production of real goods. The result is not immediate collapse. It is something more deceptive. It is the slow erosion of purchasing power disguised as growth. The 1970s offered a glimpse of this dynamic when gold surged and currencies lost credibility after the abandonment of the Bretton Woods system. But today's environment is more extreme. Debt to GDP ratios across major economies are far higher than they were half a century ago. Supply chains are more fragile. Energy systems are more politicized. Geopolitical fragmentation is accelerating. In Europe, structural energy costs continue to pressure industry. In the United States, fiscal deficits remain massive, even during periods officially described as economic expansion. In China, property market instability and capital controls reflect deeper structural imbalances. Emerging markets, facing dollar-denominated debt, are forced to defend currencies while importing inflation. Every major economic bloc is managing a different version of the same crisis. Too much debt, too much currency, and too little real growth to sustain both. This is why precious metals are not merely rising, they are repricing the credibility of the monetary system itself. Now we need to look at the global confirmation signals, because the truth of a financial shift is never visible in one market alone. Physical demand for silver and gold continues to diverge from paper markets. Premiums on physical metal, especially in parts of Asia and the Middle East, have periodically widened as investors and institutions seek direct ownership rather than derivatives. Industrial demand for silver, driven by solar infrastructure, electrification, and semiconductor manufacturing, continues to tighten supply. Mining output has not kept pace with consumption, and years of underinvestment in new projects are now revealing the structural deficit. At the same time, margin increases on futures exchanges have triggered forced liquidations, creating temporary price drops that mislead observers into believing the trend has reversed. But these drops are mechanical, not fundamental. They are the result of leverage being flushed out, not demand disappearing. And while this happens, central banks themselves continue accumulating gold at rates unseen in decades. They are not doing this for speculation. They are doing it because they understand the trajectory of currency risk. One market is revealing the true price. Another is suppressing it temporarily through leverage, derivatives, and forced positioning. The tension between these two realities cannot persist indefinitely. This is where the system begins to crack. But there is another contradiction, one that reveals the psychology of the moment. Despite historic increases in precious metals, despite rising geopolitical instability, despite record debt issuance, large segments of the public remain indifferent. Cash balances remain high in many regions. Short-term instruments are still perceived as safe simply because they are liquid. Liquidity, however, is not safety when the unit of liquidity itself is eroding. Holding cash in a high-debt, inflation-prone environment is not neutral. It is exposure to silent depreciation. The loss does not appear dramatic on a single day. It accumulates invisibly, year after year, until purchasing power has been hollowed out. This psychological lag is the last stage before a repricing accelerates. People do not react gradually. They react suddenly, collectively, and often too late. History has shown this repeatedly. In the late stages of currency debasement cycles, the public moves in waves. First, a small minority recognizes the shift. Then institutions begin to adjust. Finally, the majority reacts, driving prices vertically in a short period of time. Silver historically has been the metal that moves last but moves fastest. And now we need to confront the final verdict, the point that few are willing to articulate openly. The global financial system is not approaching a normal recession cycle. It is approaching a regime change. The old framework, built on low debt, stable energy, and credible currencies, no longer exists. What replaces it is still forming, but the transition itself is turbulent. Time behaves differently in such periods. Price movements accelerate. Settlement delays increase. Liquidity evaporates in moments that previously would have taken months. Volatility becomes the default condition. In this environment, the greatest risk is not dramatic collapse in a single day. It is the slow realization that the rules have already changed while most people were still using the old map. You are witnessing the early phase of that realization now. Silver moving toward levels once considered unimaginable. Gold redefining what a currency unit means. Debt continuing to expand because it cannot contract without triggering insolvency. Central banks balancing on a line that grows thinner every quarter. This is not noise, this is transition. And transitions in monetary systems do not happen often. But when they do, they reshape generations. The warning signs are visible, the data is public. The signals are flashing in multiple markets simultaneously. Yet the majority still believes stability will return, simply because it always has before. But history does not guarantee repetition of comfort. It guarantees repetition of cycles. And this cycle is entering its final stage, whether most people see it yet or not.